Hello, ladies and gentlemen. I welcome you all to our second part on this week's video, where we'll be tackling three international accounting standards. That is International Accounting Standard number 37, number 16, and IFRS 9. Okay, and these are the only items which we would be covering. As you can see there are some provisions, contingent liabilities and contingent assets, property, plant and equipment, and then irrecoverable debts and allowances. Okay, so those are the three areas. In our part one, the first part, we did cover the provisions, contingent liabilities and contingent assets. So this one is done. Okay, this one is actually done. We have covered this one already. Now we are focused with property, plant and equipment, and then irrecoverable debts and allowances. These ones are the subject of this video. All right, so once again, my name is Mr. James Timkulu. I'm the lead Acca tutor at Transcal Consulting Services. So if you want to get in touch with us, please feel free to contact us anytime, 24/7. Okay, 7 days a week, 365 days a year. We will always be online. You can also send an email to us via that email address. And don't forget to visit our website at www.transcalconsulting.co.zw. You always get whatever thing you need on that particular website. All right, so this is us, ladies and gentlemen, and don't forget to scan. Okay, don't forget to scan if you feel that you can give a hand and support us through this course of sharing knowledge to the ends of the globe. Right, so without wasting your time, ladies and gentlemen, let us get straight to business of the day. So property, plant, equipment and recoverable debts are issues to do with International Accounting Standard number 16 and IFRS 9. Okay, the objectives of the lesson by the end of this presentation is to be able to explain the provisions of International Accounting Standard number 16, which is property, plant and equipment, and then account for irrecoverable debts and allowances, which I said this is an issue to do with financial instruments. All right, now the provisions of International Accounting Standard number 16. Here we are only going to touch a bit of the provisions, because in our previous week's lecture, that is week number 3, we did cover depreciation and revaluation of non-current assets, and in that video everything you need to know about PPE is actually found there. But remember, these videos are meant for initial studies, foundational studies in accounting. Okay, so the standards are not going to be dealt with deeply as you would expect in a complex situation. All right, so don't expect to find issues to do with taxation as it regards to the revaluation of assets and so forth. Don't you need not to worry about those ones. Those are complex issues to be dealt with in other videos, where we'll be dealing with complex financial accounting situation. All right, so here we are only targeting the basics. All right, so here are the main points as regards International Accounting Standard number 16. The conditions for recognition of a tangible non-current asset are that it is probable that future benefits will flow to the enterprise from the asset. So for us to recognize an asset, we should be assured that future benefits are going to flow to the entity. All right, so that's the first recognition criteria. all right, which we should apply, then the cost of the asset can be measured reliably. Similar, the same as we noticed when we were dealing with the provision, that there should be some reliable estimate. In this case, we are not talking of the estimate, but we are talking of the measurement of the cost. The cost should actually be reliably measured. Then depreciation should be charged over the useful life of the asset. Land normally has unlimited life and therefore does not require depreciation. An upward revaluation should be credited to a revaluation reserve, and downward revaluation should be charged as an expense in the statement of profit or loss. If one asset in a class is revalued, then all assets in that class should be revalued. These points should be noted, ladies and gentlemen, because this is a rich pool of examination questions where you will be tested on the theory of accounting with regards to International Accounting Standard number 16. Now, the disclosure requirements. The following should be disclosed in the financial statements. The method of the depreciation used, okay, whether you're using straight line or reducing balance method. You need to disclose that within the notes to the financial statement. Then the total cost of each asset heading and the related accumulated depreciation at the beginning and end of the period should also be disclosed. Then a reconciliation of the net book value at the beginning and end of the period showing additions, disposals, revaluations, and depreciation should also be disclosed. Okay, now let's move on to the irrecoverable debts and allowances. All right. In many companies, okay, or many companies the world over, they do offer credit facilities to their customers to enable them to purchase goods before they pay. All right. They just take the goods or procure the goods on credit. Now, in the exam, you may be asked, why do we do such a thing? What are the benefits of offering credit to your customers? Benefits of offering credit facilities. Okay, this enables the business to enter new markets. Because competition is stiff, so it is actually better to offer credit to your customers so that you lure them, okay? You lure them into a long-term business relationship, all right? So if you cease on cash and carry, then you're going to be out of the business, all right? To increase sales. Remember, more sales, more money, okay? So by offering flexible credit arrangements, then you are going to increase your sales, okay? To win customer loyalty. All right, customer loyalty will be encouraged. However, there are disadvantages associated with this with credit facilities. What are the disadvantages? Okay, or let us just call them costs related to the offering of credit facilities. What do you think? This could be costly, okay? Costly as customers will pay later. Remember, we would have procured those goods on borrowed money, okay? So we'll be incurring, finance charges over those goods which have been taken on credit by customers, and these customers might pay later, all right? And if they default, then we are going to be in danger. If they do not pay for those goods, we are going to be in danger. So it is actually a costly technique to the business. The other issue is cash flow constraints. Will be constraining our cash flows. Okay. Cash flow constraints. All right. The business is likely to endure some periods of cash flow constraints because customers would be allowed to just go away with the goods for free, okay, and then pay later, all right? So that arrangement would impact negatively on our cash flows because we would be forced to look elsewhere for money, and that money might be at a higher interest charge, all right? So it is an issue of cash flow, all right? The other point should be risk. There is a high risk. Okay. Let me just say potential, not high risk, but potential. There is a potential risk for bad debts. That's another cost. Those people might fail to pay us. That is a danger with this particular arrangement. So what do business do? There is what is called an aged businesses often do what is called an aged receivables analysis. This is usually done to ensure that our receivables are well monitored and controlled. All right. The idea is to ensure receivables are monitored and do not delay payments. All right. So the analysis would be keep track. The analysis will keep track of the length of receivables or outstanding debts. By length, we are simply referring to the time, okay, when the receivable has been outstanding. All right. So we need these aged receivables analysis. Okay, it will tell us which debts are still within the 1 month threshold, which ones have exceeded, and which ones have exceeded by 1 month or have exceeded by 2 months, and so forth. This receivable analysis would ensure that we know what is going on Also, it will also allow us, or it will ensure that follow-ups are made. Follow-ups are made with the receivables themselves. So it ensures follow-ups are made. Would then contact our customer and find out what is going on with them. All right, so but why do we need to have an aged receivables analysis? This is because we need cash flows. Okay, so if we do not monitor or pursue these receivables, these customers, the credit customers, we are going to be out of cash flows. All right, so we need to ensure that we monitor them, we make follow-ups, we conduct them, and remember, to just conduct customers haphazardly might annoy them. Okay, so they have to enjoy their credit, the credit facility of the company through some informed business practices. All right, so by having an aged receivables analysis, will be in a position to conduct those customers which need to be conducted. There's no point in conducting everyone else, because if you conduct everyone, some of the customers would have taken the credit just last week or yesterday, and that might end up annoying them. All right, so by having a structured receivables and aged receivables analysis, we would be able to know who should be conducted and who should not be conducted. We would also be in a position to know which customer is actually imposing a high risk of default and which one is not. So that is the thing. All right. The other thing at this level is to understand the issue of credit limit. Okay, credit limit. Let me just try to find another pen. Why is this thing required? The issue of credit limit is based on the notion that customers are not the same. Okay, customers are not. They are different. Okay, they are just not the same. So one customer could be in a position to pay whatever debt that he is given or that is available to him. Others do struggle. Okay, so there is need for us to determine the credit limits of customers. How do we do this? We can have some references. We can make use of credit agents. Credit agencies. Okay, they might help us in determining the credit rating of a particular customer. Okay, we can also do that by requesting their particulars, their bank statements, and so forth before we grant them credit. All right, then by the end of the day, we would be in a position to know that this customer should be allowed to take credit up to this level, and this one can go as much as this threshold. Okay, so we can't actually give anybody a credit facility for $1 million. Some of them would actually disappear with the money. All right, we also need to know their business history. Okay, some are just habitual truants when it comes to business ethics. Some just do want to take the goods and go without worrying about being arrested for default or being blacklisted on the financial bureau, financial credit bureau. So they do not worry about the efficacy, about the consequences. They are actually a risk to our business. So we need to have some credit limit per each customer. Some customers will be given a zero credit limit, which means they are not allowed to be given a credit. So we have to be very vigilant, we have to be very observant, we have to be very professional when we are awarding credit facilities. All right. So the idea of having a credit limit is just to reduce risk of default. All right. But on the other hand, the issue of this credit limit is also designed to boost customer confidence in us, boost customer confidence or trust. All right. How does a credit limit boost trust in a customer? Okay, if we allow a customer to take goods up to a certain level and not to another level, that simply signifies that we are very professional people. We are determined, or we have passion for our business to grow and to endure, and that we are ready to survive. All right, we are destined, or we have the will to be in business for a foreseeable future. All right, so when we tell the customer that, I say, you are not allowed to buy goods above $200,000, that gives a sense of responsibility in our customer, such that they end up being confident that we have got business continuity in mind, and also we are a forecast organization which is responsible and business forecast. So that means they will be having some trust in us, that even if they want to do a long-term business with us, they will be so confident, they will be having trust in us. All right. So that actually happens with informed customers. Others might begrudge and say, why are they looking down upon me? Why are they despising me? Why are they not seeing how worthy I am? So some people might have some negative perceptions about that arrangement, but the majority would actually have confidence and trust in our business dealings. Okay, so this credit limit issue is actually part of the credit control system of an organization. All right, I'm sure we've discussed much on this. Let us go a step further. All right, irrecoverable debts and allowances. In this part of the slide, we'll consider what a company should do in the situation where an accounts receivable does not pay his debt, or where there is some doubt about the eventual payment of all or part of the debt. We will examine both the accounting entries and the presentation in the financial statements. An irrecoverable debt is where we are reasonably certain that the receivable is not going to pay. So if we are actually certain, all right, this will be will be considered an irrecoverable debt. For example, excuse me, the customer may have died, leaving no assets, or may have disappeared without trace. So in that case, we consider that customer an irrecoverable debt. Then, a doubtful debt is where we are worried that the receivable might not pay. For example, the debt may have been outstanding for some time and the customer may not be replying to letters. In that case, we are not sure actually if the lack of reply signifies that he can't pay. So in that case, we consider him a doubtful debt. Note that obviously if a customer refuses to pay, we are at liberty to take them to court. However, it may be that the cost of going to court will be more than the amount of the debt, and that therefore we decide not to do so. How do we treat bad debts and the doubtful debts in our books of accounts? It is important that we do not overstate assets in the statement of financial position. The prudent rule, the prudence rule we talked about when we were discussing the provisions, contingent liabilities, and contingent assets. All right, remember the prudence rule. All right, we mustn't overstate assets in the statement of financial position. Okay, and that therefore we should only show receivables that we feel confident will pay us. Okay, equally, if we realize that we might not receive payment and therefore lose money, we should show this as an expense in the statement of profit or loss as soon as any doubt arises. This is a similar approach to the provision rule. Okay, it's actually a similar approach to the provision and contingent liabilities rule. The way we did to the contingent liabilities. All right, the sooner we expect that we're going to pay, we have to consider whether to recognize a provision or to disclose a contingent liability. All right. Similarly, in this case, the sooner we realize that there is doubt attached to the potential of a receivable giving us money, then we should immediately consider disclosing the fact within our statement of profit or loss as soon as the doubt arises. So as a result, the treatment is as follows. Irrecoverable debts, these are removed completely and will no longer appear as part of accounts receivable. What about doubtful debts? We will leave the debt outstanding as part of the accounts receivable because we are still trying to collect the money, but we will deduct from receivables an allowance for receivables equal to the amount of any doubtful one, so that the net figure left in the statement of financial position is the total receivables for which we foresee no problem. Now, there are two allowances we have to worry about. There is what is called a specific allowance for receivables and a general allowance for receivable. This is a specific allowance for receivables. It's an allowance for particular or specific dates. We actually really know these dates. Okay, for example, that guy who is no longer replying our letters, he's actually a specific date where we know that there is a problem. For example, the debt has been owing for a long time. Then what about general allowance? A general allowance, this may be it may be that in our company, it is the nature of the business that on average 5% of our debtors end up not paying. However, it may be that at the year end, all of the individual debts are reasonably recent, and we have no way of identifying which particular customers will end up not paying. Okay, so we do feel, however, that probably 5% of them will not pay. Again, to be prudent, we will deduct 5% from the receivables to leave only the amount we are reasonably certain of. And as this 5% does not relate to any specific customer, we call it a general allowance for receivable. So in all cases, the cost of removing irrecoverable debts and of allowing for doubtful debts is charged as an expense in the statement of profit or loss. So when we are talking about specific, we really know that the debt or customer. In this case, we really know that this particular customer is actually having problems. But when we are talking of the general allowance, okay, this is based on our overall assessment or general assessment. Okay, it could be through history, all right, that on average about 20% of our debtors do not pay. Now let us try example A. All right, at the end of the first year of trading, there is a balance on the receivables account of street of 62,500. On investigation, this amount is found to include two debts from A PLC and B PLC, which are to be regarded as irrecoverable. The amounts owing are 2,500 and 1,600. All right. In addition, there is 2,800 owing from Z PLC, which is regarded as doubtful. Street has a policy of maintaining a general allowance for receivables of 4%. Show extracts from the statement of financial position and statement of profit or loss of Street. So let's start by workings. Okay, receivables. Okay, receivables. The total figure is 62,500. As given here. That's the balance we have been given. All right, but this balance needs to be adjusted because we have been told that specifically APOC and BOPOC are to be regarded as irrecoverable. So this one should actually be removed completely because, as you have noticed here, irrecoverable debts, these ones are removed completely and will no longer be part of accounts receivable. So we need to remove them completely. So that's 2,500 and 1,600. These ones should be removed completely. Okay, so this should give us, let me just do my calculator here. That's 58,400. It's the dollar sign. Okay, what about working number 2? All right, the working number 2, let us now determine the allowance for receivables. All right, let me try to have a more clearer pen, to use a more clearer pen. That one is 58,400. Okay, here it was 58,400. Okay, then working number 2, the working number 2, the allowance for receivables. Doubtable. It's doubtful. Oh man, oh man, oh man. It's now an issue of inertia. Okay, doubtful. That's okay. We are told basically the allowance that should be given as being general is 4,000. It's 4%. Okay, that's the percentage that should be given as doubtful in general, so the general allowance. So we are going to have two allowances. Okay, there is the first one here for 2,800. Okay, so we have got specific allowance, which is 2,800. All right, and we have, let me change my pen here, because we then have got the general allowance. The general allowance, now we are told that it's based on 4%, so that's 4%, okay, multiplied by the figure now here. That figure is into play, so that's 4% multiplied by in bracket 58,400, but it's no longer the full 58,400, because we have got a specific allowance we need to consider. All right, we have to first deduct the specific allowance of 2,800. Okay, this amount, okay, should be deducted from the receivables figure. All right, so we close our bracket. So if we use these figures, let me just try to calculate in my calculator here. All right, we should get 2,224. 2,224. All right, so we now, these specific allowances and the general allowance should be added together, so this should give us about 4,205. So the total allowance for receivables is 5,024. All right, so we then have to slot in the figures into our books of accounts. All right, so in the statement of financial position, okay, extracts from SFP, extract from statement of financial position, which was normally known as the balance sheet. We're going to have under the current assets, okay, because remember, receivables are current assets. All right, current assets. So we are going to have receivables. All right, the receivables were this one, 58,400. So that was the receivables figure. However, we have to deduct, okay, you have to deduct the allowance for receivables. So this allowance for receivables or doubtful debts. Okay, remember, you have to highlight to the examiners that these figures have been worked. That's working 1, working 2. All right, working 2, that's 5,024. All right, so this one is a negative figure. It is reducing our receivables to 53 6 there. All right, so that's 6, that's an 7, okay, that's a 7, and that's a 3. All right, that's it. So that's 53,376. All right, what about in the statement of profit or loss? All right, let me try to find another pen. extract from statement of profit or loss. Okay. In the statement of profit or loss, remember these irrecoverable debts and the provision for doubtful debt or the allowance for doubtful debt, these ones are expenses altogether. So what happens is we're having the expenses section, expenses section. We've got irrecoverable debt, irrecoverable debts. Okay, the irrecoverable debts, we are having two of them, this one and this guy, the 2,500 and the 1,600. So these ones should be added, and when we add them, we should get 4.1. All right, and then we go to the allowances for doubtful debts, right? But we only have to take the increase, okay? All right, so this is our first year of trading, okay? This is our first year of trading, so our allowance is increasing from 0 to 5,000 to 5,024. It has increased from 0 to 5,024. So we are just doing the same thing as we did with the provisions in our first video to this week's lecture, okay, on provisions, contingent liabilities, and contingent assets. Please refer to that video for you to understand this video. So the increase in allowance or in doubtful debts, the increase has been 5,024 because we are in our first year. But you discover that in subsequent years we will then have to gauge based on the increases from 5,024 up to those figures. Okay, the difference is the only movement that will be necessary. Okay, so we then have to add up the total cost, and we should get our 4,219. So this is the total expense that should be considered in the statement of profit or loss. What about the accounting entries? Each individual entry that can be required is very easy. The problem in examinations results from the fact that there can be many accounting entries required in a question, and it is easy to get lost. We'll illustrate the necessary entries in the following two examples. All right. So there is this particular example, example B, where we have got Edwin. All right. Edwin started business on 1 January 2000. As at 31st December, the balance on her receivables account was 82,000. Upon investigation, this was found to include the following debts. John owed 5,000, which is irrecoverable. George owed 8,000 and is a doubtful debt. Paul owed 3,000, which is irrecoverable. Anne owed 2,000 and is a doubtful debt. In addition, it had been decided to have a general allowance for receivables of 4% of the remaining debts. Write up the receivables, the account receivable, irrecoverable debts expense, and allowance for receivables accounts. Show extracts from Edwin's statement of financial position and statement of profit or loss. All right. So I think, and I'm very confident that this example is going to help us understand everything. Okay, there won't be any need for us to do the third example. This example is actually going to lead us to the land we aspire to be. All right, so let us do the workings as we did before. All right, so let us calculate the allowance for receivables. Do I have enough space? Yes. All right. Calculation for allowance for receivables. Okay, we have this information there. All right. Let's determine which one is specific and which one is general. Okay. All right. So I'd forgotten one thing here. I'd forgotten one thing before we move to the computations of allowances. We need to establish the receivable figure. Okay, we have to establish the receivable figure after taking into account those receivables which are no longer recoverable. All right, so we are given our balance of 82,000. Okay, this is the balance, 82,000. All right, but we have to remove irrecoverable debts. So less irrecoverable. And irrecoverable debts, there's this one, okay? There's also this one. They've been tagged irrecoverable, so there is 5,000, okay? There is 5,000, okay, plus 3,000. So we are having 8,000. All right, so this should be deducted from 82,000 and we are left with 74,000. This is the total receivable balance we have to work on, all right, or we have to work with. So for us to calculate the allowances, it's now easier. All right, so let's start with the specific allowance. Specific allowance, according to the information in the scenario. The specific allowances, we are told that George is being doubtful, okay, this one, and also this one. These are specifically identified as doubtful, so that's 8 plus 2. Okay, we are having 8,000 plus 2,000, which gives us $10,000. And then there is a general allowance. General allowance. Allowance. We say percentage allowance from the question, 4%. All right. So that's 4% multiplied by the receivables figure before deducting the specific allowance. The receivable figure is this one now, the adjusted receivables figure, all right, which is 74,000. As we have calculated here, please, ladies and gentlemen, don't be confused. We are talking of this figure. Okay, this is the figure we are talking about, 74,000. So that's 74,000 less specific allowance. The specific allowance is this one, okay, less 10,000. And we then have to say 64,000 multiplied by 4%, 64,000 multiplied by 4%, and we get our 82,560. We then have to add up these two figures and we get 12,560. All right, once we do this, ladies and gentlemen, we are now safe to compute, to draw up. Let us draw up our, because the question wants us to draw up the accounts receivable T account. So the T account for this, for the accounts receivable, we just have to present this information here in a account format or in a T account. So what we do is we just have to say receivables account. Okay, receivables account. All right, the receivables account, it's going to have this amount. All right, but we just have to bear in mind that this was the initial position. All right, because it should be adjusted after taking into account the accounts, the allowances. All right, the allowances. All right, so we are going to have that information, the balance for the receivables according to the information, the balance. Remember, receivables are assets, so by default the balance should be on the debt side was 82,000. Okay, the balance was 82,000, and we are then told that there are other guys who are irrecoverable, and the irrecoverable. The first one, recoverable. The first one was 5,000. The other one 3,000. And irrecoverable 3,000. Okay. We then have to add them up. 82,000. 82,000, and then we have got a balance CD of 74,000. So that's the same information which we did compute there. Okay. Now, let's have the allowance for receivables. All right. Allowance for receivables account. All right. This one is more of a provision. Okay. It has got a credit entry. Okay, it has got a credit entry. All right, so from our computation we determined that the amount was 12,560. all right, so we just have to credit this allowance receivable with the irrecoverable amount. Okay, that's 12,560 as we have computed there. Okay, because we are simply saying we are of the opinion that these guys are likely not to be recovered. Okay, there's a likelihood that we might not recover these guys. Then we have got all right, we did cover the allowances for receivables. What about these guys? Recoverable debts expense. All right. This one is a bit tricky. Okay, this one is a bit tricky, but let us see if we can come up something meaningful. All right. The name of the account: Irrecoverable debts expense. Irrecoverable debt expense. Okay. The account which is being affected here is the receivables account. All right. So we need to remove these guys from the receivables account. All right. And do away with them completely. All right. So by the end of the day, we are going to end up having the total of the expense that is to be transferred to the statement of profit or loss. But what we know is these two guys are irrecoverable, but at the same time there are other guys here who are doubtful. Okay, the 12,560 are doubtful. All right, so the expense is going to have these guys who are irrecoverable. There's 5,000. There is also a receivable for how much? For 3,000. Okay, and there's also an allowance of 12,560. Right, all of these should be transferred, okay, to, if we add them up, that's 8 plus 12, that's 20, 560. Okay, this is the total that should be a charge to the profit or loss. Okay, the statement of profit or loss should have this total as the charge for that year. Okay, and that is it. That is it. All right. All right. Okay. Like I said, we then have to consider the impact of the allowance. So the ultimate receivables account should actually show the impact. Okay, as I have already indicated, the ultimate receivables account should show, this is the ultimate now, right? Receivables account, right? The receivables account should then show this balance CD. This balance CD should then appear here. Balance BD now should be balance BD 74,000. Okay, and then we need to consider the allowance not the allowance, but the receivables allowance in total. Okay, yes, all right. So the allowance receivables, it's fine. Receivables in total, all right, of 12,560, and then we should have our new balance CD. Okay, 74,000. So the new balance CD should actually be the difference there, which um let me just try to use this calculator of mine. Sometimes it sticks, this calculator. I don't like the way it behaves. Okay, like now that's 74,000 minus 12,560. We are having 61,440. That's the ultimate balance for receivables. Okay, we should find at the end of the year, after taking into consideration all the irrecoverable debts as well as the allowance for receivables. Okay, now can we summarize what we have learned so far with regards to these irrecoverable debts so that we can rest our case? All right, irrecoverable debts. The irrecoverable debts these are the amounts, okay, which the business is not going to receive. All right, the business is not going to receive these monies from its customers. The reasons why they are not going to receive them is either the customer has gone bankrupt, okay, has gone bankrupt, or the customer has gone into bankrupt, or the customer has just vanished, okay, has vanished into thin air, or is disputing, the customer is disputing the invoice amount and so forth, or the quality of the goods. There are so many reasons. All right, this is, I mean, the issue of vanishing is associated with fraud. There could be some fraud. It could be an issue of fraud where the customer defrauded the company. All right, what about the allowance for receivables? This signifies that, all right, let me just try to say allowance for receivables. Okay, there is doubt. There is doubt on the collectability of the amount. Okay, there is doubt. For example, we try to send them letters or statements, but they are not replying, they are not coming forth to discuss with us what the problem is. They are just silent, so there is some doubt. All right, so an allowance is made to recognize the potential of default. The potential of default. Okay, so how do we account for irrecoverable debt? How do we accounting for irrecoverable debts? All right, remember, irrecoverable debt is an expense, so you debit irrecoverable okay, debit irrecoverable debt expense. Okay, um, and credit what? What are we crediting? Obviously, we are reducing an asset here. All right, we are reducing the asset receivable, so we are crediting the asset receivable. Okay, so we are crediting accounts receivable. That's the double entry which we do when we want to just do away with those debts which are irrecoverable. What about accounting for the irrecoverable debt that has been recovered? Because sometimes even if we would have cancelled the irrecoverable debt from our records, some of them might come up. Let's say they had vanished to South Africa to look for greener pastures, and then they now have the money, and they are saying that, hey, I do not want to go to hell. I want to die with a clean sheet. I don't want to be punished, whether by karma or, they've got their own reasons, be they spiritual or biblical or just out of business etiquette. They just feel that they want to be good people. No more hassles, no more blackmail. They just want to make amends. So how are you going to account for that? Obviously, okay, let me just try to write in red. Accounting for bad debts recovered. Obviously, if they pay, okay, we are going to receive money and we debit asset cash. But what do we do then? We have to credit, okay? We have to credit irrecoverable debt. Why are we crediting this? Because originally we had debited this guy. So we are recovering the money. Therefore, we have to credit them. What about accounting for allowance for bad debts? Accounting for allowance for receivables. Accounting for allowance for receivables. This is, remember, this is to account for the differences or increases or decreases in the allowance. Okay? The movement. We are worried about the movement of these allowances. All right? So, if there is an increase, okay, if there is an increase, we have to, all right, if increase in the allowance, we just have to debit, okay, we have to debit irrecoverable. Debt expense and credit the allowance receivable. Remember the allowance for receivables. The allowance for receivables is almost like a provision. Okay, it's almost like a provision. All right, so that's what happens if there is a decrease. If a decrease we do the reverse. So we just simply reverse what we are seeing there. Okay. I hope, ladies and gentlemen, we have been helped with this short video. Okay, we were trying to actually polishing up everything to ensure that we have been catered for adequately. All right, so if you really feel you need this bigger life, the Acca life of accountants, all right, please just get in touch with us. All right, at Transfer Consulting Services, we are ready to serve you guys. We are at your service actually. All right, we are just at your service, and we are committed to ensure that every Acca student passes his Acca exams within the shortest possible time. All right, so those are our credentials, and we look forward to have you in class. All right, and do not be left behind. There's so many benefits if you become a former student, or if you start Acca with us. All right, our package includes reading. Okay, you get access to reading materials. Okay, assignments, videos, okay, 24-hour right round the clock tutor support anytime. Even if when you dream seeing figures running everywhere in a nightmare, you just have the right to call your Acca tutor to tell him, hey man, you can't sleep because you are facing a challenge on a particular assignment, or on a particular question, on a particular topic, and you need some explanation. You just have to contact them anytime, anyhow. Okay, we don't sleep at Transfer Consulting Services. We don't sleep. Okay, we are always there for you. So anytime is tea time. All right, so please just feel free. All right, just feel free. All right, if you see this video, or if you have found it helpful, and you feel the urge to support us, all right, just buy us a coffee, okay, at the available link there. You can just follow that link, and you can make your donation. All right, until next time, ladies and gentlemen, may the good Lord continue to bless you. All right, I am signing out. Thank you.